Hey everyone, welcome back to Corporate Decoder, Liberty Star Uranium and Metals Corp. LBSR just filed an 8K and it looks like they are raising some cash with a new debt agreement. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is bringing in new money, but the terms are definitely something we need to unpack. Alright, so what did Liberty Star Uranium and Metals Corp announce? Well, they entered into a securities purchase agreement with a company called 1800 Diagonal Lending LLC. Basically, this is an agreement to buy and sell securities, which in this case means Liberty Star is selling something to get money. The big news here is that Liberty Star agreed to issue a convertible promissory note to 1800 Diagonal. Think of a promissory note as an IOU, essentially a loan. This one is for a principal amount of $73,700. That is $73,700. This agreement was made on the 15th of June 2026, but the note itself was actually issued a few days earlier, on the 11th of June 2026. Now, let's talk about the terms of this loan. It carries an interest rate of 8%, but there is also a 10% original issue discount. This means that effectively 1800 Diagonal is lending $73,700, but the company only receives less than that amount because of the discount. Or the discount is subtracted from the principal at the time of issuance. So the actual cash received might be less than the face value of the note. This note matures on the 15th of March 2027, which means it is a relatively short-term debt, less than a year from when it was issued. Here is where it gets interesting. This isn't just a straight loan that needs to be paid back with cash. The outstanding principal and any accrued interest can be converted into shares of Liberty Star's common stock. This is known as a convertible note. This is common for smaller companies, but it can lead to dilution for existing shareholders. Basically, if the stock price goes up, the lender might choose to convert the debt into stock instead of getting their money back, which adds more shares to the total outstanding, potentially lowering the value of each existing share. This section just confirms that the company has indeed taken on a new financial obligation, which is this convertible note. It is not an off-balance sheet item, it is a direct financial obligation. Now for the paperwork, they've officially filed the actual documents. This is the actual convertible promissory note itself, dated the 11th of June 2026. And this is the securities purchase agreement, the contract that laid out the terms for this deal, also dated the 11th of June 2026. These are the documents that would contain all the fine print about conversion rights, interest calculations, and any other covenants or conditions. And here are the signatures confirming that the company executives have reviewed and approved this filing. Patricia Madaris, the VP of Finance and CFO, signed off on this on the 17th of June 2026. So what does this all mean for Liberty Star Uranium and Metals Corp? They are securing necessary funding, which is crucial for a company in their industry. However, convertible notes can be a double-edged sword. On one hand, they provide capital without immediate cash repayment. On the other hand, they can lead to significant dilution for existing shareholders, especially if the stock price is low, making the conversion option very attractive for the lender. This $73,700 might be a small amount in the grand scheme of things, but the terms of conversion are key, given that Liberty Star Uranium and Metals Corp has a very small market cap, around $3 million, and the stock price is very low, in the pennies. A convertible note like this can have a substantial impact. If the company's stock were to increase in value, the lenders could convert their debt into a large number of shares, potentially flooding the market. We've seen companies, particularly in the microcap space, struggle after issuing such notes, as the dilution can put significant downward pressure on the stock price. It is a common strategy for companies needing operating capital, but it comes with a cost to the existing equity holders. The fact that they are issuing this note shortly after reporting their first quarter earnings, where they also warned about going concern, meaning there is doubt about their ability to continue as a business, highlights the ongoing financial challenges they face. The convertible note is a way to address immediate cash needs, but it does not solve the underlying issues that led to the going concern warning. It is a band-aid solution. Essentially, looking at the historical context, companies that rely heavily on convertible debt often find themselves in a cycle of continuous dilution and financial distress. It is a path that has led many smaller companies to eventual delisting or bankruptcy. For example, companies like Radio Shack saw multiple rounds of dilutive financing before ultimately filing for bankruptcy. It's a pattern that investors need to watch very closely. The risk I am watching is how much dilution this convertible note will ultimately cause, and whether the company can generate enough revenue and profit to become self-sustaining. or if more dilutive financing will be needed. What I am actually looking for is a clear path to profitability that does not rely on continuous debt conversion. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded, like, comment, subscribe, and join our Discord for more.